thank you, everybody. This is an exciting opportunity to talk. As Tony mentioned earlier, all of us have worked with, and many in the room have worked with hundreds of different universities and how to go about thinking about this and what are the issues associated with it. And there are a lot of different ways that people have approached this. I wanted to share one example. First up, there's no perfect right solution and there's no one solution, which I think everybody is grappling with. One experience we've had more recently was a university on the East Coast that was trying to figure out not just what to avoid, but how to engage the community that was the university. And what they ultimately did was they surveyed the entire university community. They launched an online survey. And the impetus for this was the divestment movement in fossil fuels. But in their internal discussions, what they realized was it wasn't a singular issue. If they were going to make a decision about what was right for them, they needed to think holistically about what their values were as an institution and how they were going to go about reflecting those. So they did something that seemed very risky up front. They asked everybody. They asked staff, they asked faculty, they asked students, they asked alums. And they were clear that this was not a democracy. It wasn't a vote. It was an informed autocracy. But they wanted to know what mattered to people and the people that they cared about, and they wanted to engage in this dialogue. And they launched a survey to figure out what that was. And they used that to inform what ultimately became their investment policy and their social profile that they then worked with their consultant to convert into a mandate and an investment solution. And that's what's going on today. But before we can get to where we are today, I thought it would be helpful to start with where we've come and understand the history and how things have evolved. And in looking at that, there's really nobody better than Bennett Freeman to start there. And rather than spend time on his bio, which you can read in your pamphlet, we thought we'd get to the stuff that you can't read about and have him talk about where it started, how it's evolved, whether it's been South Africa, Sudan, tobacco, and now the divestment movement, and how things have changed over time. So Bennett.
Thank you, Liz. Good afternoon, and really delighted to be here. And this is such an important discussion this afternoon and tomorrow. And I want to thank Tony Cortese in particular and his colleagues for bringing us all together here. So I'm going to hit your question right on the head, Liz, in two ways. First, from my current perspective at Calvert Investments, just give you a couple of minutes of how we've evolved. But then, secondly, and I think more importantly, to give you a perspective of how I think universities have evolved over the years, going back about 35 through my own experience with South Africa, Sudan, and now with fossil fuels. First with Calvert, and I think that we're a good case study of among the traditional so-called socially responsible investment firms. We've been around for almost 4 decades, and our original proposition was a values one, and very much informed by the activism of the 1960s and the 1970s, the anti-war movement, the civil rights movement, the environmental movement, women's movement, consumer rights, and so forth, and fused together, as were the original SRIs, with some of the faith-based investors who cared about some of the same issues. And together we put forward a values proposition. You could avoid investing in certain industries, whether tobacco, alcohol, gambling, weapons, and try to sort the wheat from the chaff, the less good guys and the better guys. And we've done pretty well with that approach for many, many years. But our approach has evolved, and while we have not in any way jettisoned the values that brought us to the party in the first place, we began to evolve a good 15 plus years ago into a very straightforward, hard-headed investment proposition which prevails for us today. And it's simply that investors who take into account, serious account, environmental, social, and governance issues, which will vary industry to industry, company to company, are going to probably end up doing better over the long term, given the increasing salience and indeed materiality of environmental, social, and governance issues that affect whole industries and in particular company performance. And we increasingly integrate our fundamental financial analysis on both the equities and the fixed income side with those dynamic ESG, environmental, social, governance factors, and we produce very positive returns across most of our funds as a result. I can talk about fund performance later. But let me just, the second part of the answer, I think, is the one that is probably more interesting to this audience, and that's how this conversation around responsible investing has been driven by a remarkable extent by higher educational institutions, and not just by student activists, but by university administrators, leaders, trustees, alumni, faculty. And there are three great case studies, and I had a bird's eye view, a role really in all three, although only marginally in the first one, and that was the South Africa divestment movement. That was values driven, that was political. It was about taking down apartheid by isolating the regime economically, and it had some impact, at least as Nelson Mandela claimed it did, as did those of us who were involved in the movement. I was just a bit player in the late 70s as a student at Berkeley in the movement, but it was all moral and political. It wasn't about investment return. Fast forward to the last decade, Sudan, genocide in Darfur, at UCLA, and then Berkeley and across the UC system, and then at colleges and universities across this country, pension funds, more than 24 states in this country mandated legislatively divesting from companies with a significant role supporting the government in Sudan that was perpetrating this genocide in Darfur. Once again, morally compelling, politically driven, not about investment returns, but about moral outrage and political change. And Calvert was proud to play a leading role among asset managers in the US in not only encouraging, but supporting through our research and analysis and advocacy that movement. But I'm going to end my point here with this current fossil fuel divestment movement. Yes, there's a moral basis to it. It's about saving the planet. There's a political agenda. It's about setting a price on carbon in the United States and accelerating more coordinated action globally through the UN and elsewhere to reduce much more quickly than anyone seems to be willing to do our overdependence on hydrocarbons. But there is also an investment thesis embedded in this divestment movement. And that thesis is that the US economy, the global economy, industry after industry, company after company is going to be at risk because of climate change. And if we don't move much more quickly and much more seriously, we're going to upset the entire global economic system. And we've got to move, not just because of morality, not just because of political agendas or environmental concerns, but because of hard-headed economic and investment realities. And this stranded assets thesis that's been out there, and we can talk more about it later today or tomorrow, is now beginning to gain a little bit of credibility in light of the incredible tumult in the oil markets the last couple of months, with these oil stocks plunging and with effects across all industries just about on a daily basis. So this is now an economic problem and an investment challenge to figure out what we're going to do with fossil fuels. And I'm just delighted that this movement has come about in a way to lend such focus and urgency to the broader conversation we're having today and tomorrow about what responsible investment means. Yes, it's about values, but it's also about hard-headed realities of the 21st century. Thank you.
I think one of the changes that we've seen from South Africa to today is the intentionality and the preparation of the students themselves. You know, as Bennett said, when people were sitting in on South Africa, it was moral outrage, but the students weren't armed with an investment discussion. They, you know, they weren't sleeping, they were that was a very different issue set. And today, for all of you who have worked with the students, they are going in armed with the data. And I think that has been a major change, and it is an opportunity, I think, for all of us to engage with them respectfully and know that they're coming in with that information, whether it's been received by 350 or others, in terms of that. And Bennett, if you would mind taking just a minute or two and talking about shifts in attitudes you've seen on campuses in response to that.
That's a great question, and I have been on some campuses to talk about this issue. Most recently, in the end of October at University of North Carolina, Asheville, did a session with a couple of hundred students there, and they are absolutely fired up. But the difference that I've seen, and I've been on a few other campuses around this issue the last couple of years, the difference that I see with really the South Africa movement at Berkeley, which was one of the drivers of it in the late 70s and early 80s, is that this is a cohort that doesn't just want to make the statement, but make the difference. At Berkeley, there were tactical misjudgments, strategic blunders, you know, of people thinking that the enemy was the Alameda County Sheriff's Department, and the whole objective was to get arrested, and then people spent a year in the Alameda County Superior Court fighting that rap instead of doing what they needed to do, which was to educate and change minds of the Board of Regents of the University of California system to get enough votes to get them to divest, which ended up taking half a dozen more years. This generation of students, yes, there have been demonstrations and protests, and there have been a few arrests here and there, but what I'm seeing and feeling in the conversations I have with students these days is they got their eye on the ball as to actually how to affect change. And it's not about getting arrested or taking on the people enforcing campus regulations. It's making the case, coming to the problem with arguments, with facts, with statistics. And that's how we're going to win the argument here, how they think they're going to win the argument. And so I've seen that generational change. It's not absolutely that clean cut, but that's what I see from where I sit for what it's worth.
Thank you. So I want to shift the conversation to one of probably the big elephant in the room, which is if you make a decision to align your values with your investment portfolio, what's the impact on the portfolio from a performance and a risk standpoint? And we've got one of the best people in the country to talk about it, and I will take a moment just to give some context to Tom's background, or the background of his firm, MSCI, and they really play in a number of camps, but relevant to this conversation. They represent two distinct areas that are very critical in how we as asset managers, which is what I represent, and you as endowments go about making these kinds of decisions. One is on the data side. So they are gathering data, environmental, social, and governance data on thousands of companies around the world. And that allows all of us to make decisions in terms of what's important and which companies are better or worse around these issue areas. One note on that is the more you all ask for that, the better the data gets. And MSCI is one example of it. There's Sustainalytics, Bloomberg is in this field, IW Financial, and so on and so forth. The other hat that MSCI represents or is very involved in is the index world. And for all of us in asset management, we spend a lot of time talking about how did we do relative to X, the S&P, Russell 3000, whatever it might be. And so this issue of how did I do relative performance and relative risk is very critical. So when those students go in and the endowment says, how do I think about these decisions relative to having enough assets to meet my financial obligations today, tomorrow, and decades from now, Tom, if you wouldn't mind talking about how to think about those questions and how you guys look at them.
Great. Well, thanks very much, Liz. Thanks, Bennett, for your observations, and thanks to Tony, and thanks to the folks at ASU for hosting this. If I could have a slide. This is the first slide. I thought we're at an academic institution. I should put up something with footnotes. So I did it. You can't read the footnotes, but that's deliberate. What I want to talk about for the next few minutes is the question of performance. And as Liz mentioned, MSCI's core business is stock market indexes. And the MSCI benchmarks are widely used, particularly in global investments. You know, I've been lucky enough in my career to have landed there, to be able to sort of put together my interest in ESG with the benchmarking capabilities that they have. But I thought we'd start with the academic and practitioner literature on ESG and performance. And I've cited 3 studies here. I've actually taken quotes from 3 studies and highlighted parts of them. And they all point in the same direction. And that direction is that there is no necessary reason based on either particular studies or meta-studies, studies of the various studies that have been done. There's no necessary reason why you should expect that integrating environmental, social, and governance factors into your investments should hurt performance. And there's some reason to believe that in some cases it may help improve performance. So the 3 studies, one is from Mercer, the investment consultant. It's a meta-study they did of the literature on behalf of CalPERS, the California State Pension Fund. Another is a different meta-study done by Deutsche Bank. Again, looking at surveying the academic and practitioner literature on ESG risk and performance. And the third one is a study done by RCM, which is an asset manager, of a strategy, an investment strategy that they developed using ESG data. And again, the results are consistent among them, and they all point in the same direction. Now, I'm going to shift gears a little bit, if we can go to the next slide, and just provide a little bit of real-world performance information. Essentially, as benchmark providers, we're scorekeepers. We measure markets. And we measure markets in different ways. Our core indexes, the core business of MSCI is really built around broad market capitalization weighted indexes that many of you would be familiar with in the asset allocation study plans that you have. You know, whether you're managing for an endowment, whether you're a consultant or whether you're an asset manager. In addition to those kinds of markets, we also develop a set of ESG indexes which help evaluate the risk and return of different ESG strategies. And I want to what I've done is selected different benchmarks representing both different markets geographically and different ESG strategies to look at the performance. The first one here is the oldest SRI index. It started its life as the Domini 400 Social Index back in 1990. Was eventually renamed the KLD 400 Social Index, and then when MSCI acquired the firm that acquired KLD, it became the MSCI KLD 400. So this index is what I think of as a traditional SRI index. It has a series of exclusions for issues like alcohol, tobacco, and gambling, and nuclear power, and military weapons. And in addition to that, it then uses various sustainability criteria to choose companies that perform well on those metrics. And what you can see, looking over the, I can't even tell you how many years it's been now, but I guess it's been 24 years of performance, is that over that period, and this is data ending 12/31, 2014, over that period, on average, it's outperformed. And what you can also see is that during different periods, it may underperform as well. But I think the sort of the perspective you need to take in thinking about these issues is that there will be variations in the short run, positive and negative, but you really want to understand, because you're investing for the long run, what the long run implications of these strategies are. Next slide. Thanks. So we're going here from a US universe to what ACWI, we love acronyms at MSCI, you'll discover if you work for a company whose name is an acronym. You love acronyms. ACWI is the All-Country World Index, which means it encompasses both developed and emerging markets. I've taken out the US because we just looked at some US performance. This is a sustainability index, so it's similar in many ways to the KLD 400, except that there are no sort of blanket exclusionary screens for industries like alcohol, tobacco, and gambling. And what you see here, this is an index which for the developed markets was launched in 2007, emerging markets in 2013, so some of the emerging markets data is simulated. But what you see is that over the 5-year and life of the benchmark since inception, that it's outperformed. And I also included the annual performance piece to show that on a calendar year basis, it's outperformed every year but one. This proves nothing. However, it does help us address the question, what does the return profile for these kinds of investments look like? Next slide. Here we're going a little bit out of the SRI realm and out of the sustainability realm to look at a low carbon strategy. This is a recently launched benchmark, really in many ways sort of coming out of the same context in which the divestment issues have arisen. And this is designed to at one and the same time reduce your exposure to carbon emissions and carbon reserves while tracking closely to the market. And what you see here, and again, because it was only launched in a few months ago, most of this data is simulated, but what it shows is that over the 4 years that we did the simulation, it has outperformed the benchmark. It's done that modestly. It's designed, in fact, to perform like the benchmark. Next slide. This is the next fossil fuels index, again, global, both developed and emerging markets, just excluding companies that, that own fossil fuel reserves. And it's similar in that it was launched in 2014, so a substantial portion of this data is based on a simulation. But what you see is a performance which in fact is quite different over this brief period from the benchmark, largely driven by the low and falling energy prices over the past, really since 2008. So what does this all add up to? You know, we're in a you know, this is an audience that's probably good at pattern recognition. Essentially, all of these different benchmarks which I've cited here take slightly different strategies, and they may look at slightly different investment universes from a geographical standpoint. But the data is all consistent with the studies I cited in the first slide, which is that there's no necessary reason why performance should be hurt by taking into account ESG factors in various ways. This is important because very often performance is cited as a hurdle to even beginning this conversation. And so if we can get that off the table at the beginning, it opens up the conversation about whether and how you can develop ESG policies and helps address some of the concerns about whether or not having an ESG policy is consistent with fiduciary duty.
Thank you. And you know, Tom will be around, and many of us can talk about the ways of thinking about risk and having that discussion and different measurements of it, because those are going to come up in every investment committee. I mean, they are a reality of how this business works, and how you think about that becomes very important, and understanding those measurements are important. Shifting gears to the other, if not elephant in the room, the other question that comes up a lot is around, as you implement, but does this matter? Does it matter? Did it matter that you divested from South Africa? Does it matter that you divested from it? And what are the different ways to think about the impact that these decisions on the investment portfolio have within within the world at large? And wanted to turn it over to Adam and let him talk about sort of this concept of impact and the different ways you might think about it and achieve it.
Thanks, Liz. And my father was an academic physician, and I started out my career as a labor economist. I was a professor at Wellesley College, and I taught at Boston University. And just to be here now, having then gone into the mainstream investment industry and then gone into the sustainable investment industry, I just feel like I've come full circle. And just thinking back to those days of trying to have impact when I was an academic and an educator. My poor students, and this is going back to the 1980s, I assigned John Kenneth Galbraith, who was my favorite economist. Even then he was about 80 years old. So I was assigning things that were written in the 50s and the 60s. But what I loved about his framework coming out of the post-war period was he talked about this concept of the different sectors of society having power and countervailing power with each other. So when the market is where you got growth and economic development, but these other sectors were critical, labor unions for social justice, and governments to really make sure that the rules around environmental regulations and so forth were set, so the externalities that we've talked about in the market were actually going to be dealt with appropriately. And for financial reasons, I moved from academia into finance, and I worked for two of the largest investment management organizations in the world. First, Wellington Management in Boston, and then I was the chief global strategist, so doing global asset allocation for Deutsche Asset Management in London. And I was right in the center of, I would say, the economic part of the system. And I personally found that the impact that I was having was not satisfying. That kind of impact, to just invest in what I call mainstream investing, which has no consideration of the social or environmental impact, I found alienating and not very satisfying. And I thought I would get out of the investment industry. And it was a time when globalization was leading to, I think, much weaker governments and much weaker labor unions. So the countervailing power that Galbraith talked about was really now coming into the market itself. So the market, it seemed like, was becoming everything. And to the extent we were going to have balance in the economy, it was going to come from within market transactions itself. As governments, it seemed like were getting increasingly captured by the powerful forces within the market, and labor unions became almost de minimis in terms of the United States. So I ended up not getting out of the investment industry, but 11 years ago launching a journey in this field of sustainable and responsible investing. And some of you in the room, if you're early days in this, you're exactly where I was 11 years ago. I approached it with some enthusiasm, a fair amount of skepticism, a real lack of knowledge about what it was. And shockingly, after having been in the mainstream, I knew very little about this field. I knew very little about shareholder engagement, proxy voting, avoidance screening, positive screening, impact investing. These were all things I had to learn 10 years ago. And I'm happy to say that there's been a tremendous evolution in the field and a maturation of practices over those 10 years. So I want to talk about three kinds of impact that we can have in our portfolios. And I think this gets to the way that our whole society is looking within the market to have impact. If you think about consumption systems, you think about food systems, people really wanting to understand, what are the impacts of industrial agriculture? How do I move to an agricultural system that I can touch and feel and is healthy? It's the same impetus, I think, in investing. I think what we're seeing among younger people in our society and people in general in our society is trying to have power within the market ourselves. The idea that your money is your vote. And we first saw this with consumption, and now we're really seeing it turn to investment. And there are really three kinds of impact that you can have. The first is the kind that Bennett talked about, which is the early days, which is more values alignment. And so certain practices, I think, are more like voting. You know, when we all go out to vote, it's very unlikely that our one vote is going to make a difference in an election. I think it probably never has in my experience. But it's important as citizens that we vote. And so practices like proxy voting and avoidance screening, particularly quiet avoidance screening. I'm not talking about loud divestment avoidance screening, but just saying, I'm on the board of a foundation I've been on for over 10 years called the Hyams Foundation. And we're very concerned about the school-to-prison pipeline in urban communities, and particularly among black males. And one of our trustees asked the other day, as we go down the same journey that you're going down in the Hyams Foundation, well, are we invested in something like the Corrections Corporation of America? That would be actually antithetical to what we're trying to achieve in the Hyams Foundation. We said, well, we're not sure. We may be. We haven't put any explicit screens to do that. So those kinds of activities, it may not have an impact on the world for the Hyams Foundation to not be invested in Correction Corporation of America. But it's important, just like voting is, like proxy voting is, for us to have that kind of alignment for ethical reasons. So that's the first kind of impact. If we could go on to the first slide I've got here. The second kind of impact we can have, and this is a graph that we use or a chart that we use at Arjuna to talk about the different areas you can have impact, public and private, and cutting across that equity and debt. So the second thing, which is what Bennett and I think Tom are talking about a little bit, is simply good investing, is there is an aspect of integrating environmental, social, and governance into your portfolios that will simply enhance risk-adjusted returns. That's, I think, the easiest thing to do. And if you engage with, there's someone here from the Principles for Responsible Investment. The broad take-up of the Principles for Responsible Investment, I think, is largely due to the fact that the principles are talking about environmental, social, and governance risks as risk and opportunity issues, not as values issues. So can we integrate these issues in a way that enhances returns? I think that's a fairly easy thing to do and a fairly easy question to ask. And it doesn't really change the basic framework of what you're trying to do. The third kind of approach, which I'm very excited about, and we've done a lot of work on our company around, are two things, which I'll call impact investing and shareholder engagement. So let me start with impact investing. So most of the impact investing, as people define it, and I'm defining it as investments which themselves have some sort of positive environmental or social impact. So these generally are in the private sphere. They're generally very difficult to source. They're very difficult to do due diligence on. And they're very difficult to put a diversified portfolio of these things together. So what we did at our company is put a pooled product together, which we call the Arjuna Income and Impact Fund, that's looking for a diversified return of between 3% and 4% net of fees. And I want to talk about some of the investments that are in that. I'm guessing that these are not the kind of investments that are currently in your fixed income portfolio in many cases, but they're investments that I think are quite attractive and actually have nice returns. So we have one investment in there that does peer-to-peer lending. Now, peer-to-peer lending is actually taking people that have credit card debt that never amortizes, that they might have for 30 or 40 years, that they're just paying the interest on, sometimes at 18 or 20%. Taking people out of those loans and amortizing them down at 3 to 5 years, and depending on their credit rating, at a rate of, say, 7 or 8%, 9%. And actually allows them to pay down those loans and get rid of that credit card debt. And we as investors can go in and invest in a diversified portfolio of those loans, and we're getting a yield of 7%. So I think there's real social impact of taking middle-class people, and now we're looking at a fund that's going to look at lower-income people and do the same thing and take them out of that horrendous credit card debt and put them into an investment that's actually generating a very good return for us. Now, if that's all we were doing in that fund, I think that would be too concentrated in terms of its risk. So we layer in other things. We're looking at small to medium enterprise finance in places like Brazil and Africa. These are places where medium-sized businesses are really starved for trade finance. And we're going in and providing that trade finance where the guarantee is actually the contracts they have with the Toyotas of the world that they're exporting to, and say, we'll pay you $100,000 now in order to get the proceeds from that contract in 3 months, which might be $103,000. So the interest rates are actually relatively high, but it's providing critical liquidity. And we're looking at a yield on those of 8 to 10%. So there's some high-yielding things in the portfolio, and we combine those with some very high-impact and lower-yielding investments, and we can get a combined, pretty diversified investment of between 3 to 4%. Now, I think the exciting thing about impact investing is they're investments where you can look and feel and see the positive impact and seek investments working with your financial advisor and consultant that have a direct connection to your institution and its mission. So I think impact investing is a very exciting field. However, as colleges and universities figured out the last time we had a horrible crisis, which was in 2007 and 2008, you can have way too much in these private illiquid investments. And if we look at these quadrants here, most of our investments are in public securities, in public equity, and public debt. So the question is, how can you have positive impact in those areas? And I'm particularly going to focus on public equity. So if we can go to the next slide. We're very active shareholder engagers. The interesting thing about shareholder engagement is you can do it with a small portion of assets. You don't need a lot of assets. We do shareholder engagement around natural gas in terms of methane emissions and leakages. That's something that the president has just focused on in the last week. And we want natural gas companies to measure their emissions and to reduce methane gas emissions because it's a very powerful greenhouse gas. We've looked at shareholder engagement around net neutrality, so a whole set of issues. One of the issues we're going to be talking about on the next panel is this whole issue of divestment and carbon investment. And Tony mentioned in the introduction this idea of stranded carbon assets, so I just want to use as a case study one shareholder engagement we've done very successfully over the last 2 years with ExxonMobil. Now, ExxonMobil is not widely held in our company. We just happen to have a few investors who had legacy holdings of ExxonMobil. We cooked up this idea that we wanted to engage with ExxonMobil around this issue of stranded carbon asset risk. And we approached our clients and said, would you mind if we use your shares to file a shareholder proposal? And the investment thesis here, as Tony suggested, is the second red line is how much scientists are estimating we can burn in known reserves of fossil fuels between 2000 and 2050. That's the top red line. The little black circle that's between the two red lines is what we've already burned between 2000 and 2011. And the other bottom gray circle is what's remaining that we can burn. And then the big circles are the known reserves of coal, oil, and gas. So this is the kind of investment problem that we're facing within transitioning from a fossil fuel economy to the next economy is we can't burn the reserves we have. And this creates tremendous investment risk for companies like ExxonMobil. So how did we approach ExxonMobil? We didn't approach ExxonMobil and say, you're a terrible company, you should stop burning fossil fuels. What we said is, you face an investment risk. And where shareholder engagement works is where you position it as an investment issue, as a risk issue, as an opportunity issue. So we went straight up with an investment issue and we said, simply assess the risks. This was what the shareholder proposal was. We want you to write a report to assess the risk that there's going to be a low carbon scenario that you face in your future and you're not going to be able to burn those reserves. And the investments that you're making are at risk, particularly the frontier investments that you're now making in things like tar sands and deep water drilling. Now, if we go on to the next slide, headline news, Wall Street Journal, New York Times, The Economist, with little Arjuna Capital and ExxonMobil. What was the news? The news was that we agreed to withdraw our shareholder proposal if Exxon would write that report. They were the first major integrated oil company to even consider the idea that they were facing carbon asset risk. And they wrote the report. Now, Bob Litterman here read the report along with our head of shareholder engagement, Natasha Lamb. If we go on to the next slide. And Bob and Natasha wrote essay in response to the report said, and I think the name was, Exxon left the risk out of the climate risk report. So not surprisingly, Exxon's response in writing this report was, global governments are not going to intervene. There's a critical need to burn these fossil fuels. We essentially face no risk that we're going to have to not burn these fossil fuels. Now, what was important about that is not that we changed Exxon's spots, because we didn't, but we got Exxon into the public conversation, publicly stating that this is not a risk. At the same time, 6 months later, we see President Obama negotiating with the Chinese that this is a risk and we are going to cap these emissions. So now we've engaged a debate, and investors have helped sort of launch that debate. So we think it's a very important role that you can play as a powerful owner of capital. Remember, we are the owners of corporations. Corporations do not own us. The last thing that I want to say is, going on to the next slide around this, is what are we doing this year? Well, we decided to go all Carl Icahn on ExxonMobil. What do I mean by that? Well, all right, so the first one was write a report. They write a report that's not very satisfying. Now we're going to them and we're filing a proposal that we're saying, Exxon, you've got 3 or 4 things you can do with your capital. You can invest in tar sands and deep water drilling. You can dividend your shares back to us. You can do share buybacks, or you can invest in alternative, less risky strategies. We want you to do those last 3 things and stop doing the first things. We essentially want our money back. We want you to take those profits and dividend back to us and let us reinvest in things that are less risky than your tar sands development and your deep water drilling. So those are a couple of examples, impact investing and shareholder engagement, which I think are very exciting, positive things that you can do with your assets.
Thank you. And you know, for folks that are new to the idea of shareholder engagement, whether it's proxy voting or resolutions as filers or co-filers, I think there are any number of us in the room that can speak to how to go about that and what the implications are, whether you're in a mutual fund or a separately managed account or a commingled, and ways to think about it.